This is Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 1, the time value of money. In this topic, we're going to compute the value of cash flows using present value, future value, net present value, IRR, and the payment functions. We'll use the present value, future value, NPV, and payment functions to solve some real-life problems, including calculating loan payments, savings for retirement, and evaluating an MBA investment decision. We'll also obtain some basic Excel modeling skills using functions, formulas, cell references, cell styles, graphing, solver. Let's start out with the concept of future value, or FV. A future value of a single deposit, also called a lump sum, is the value of that payment at a future date. For example, suppose you deposit $100 in a savings account today that pays 6% interest. How much would you have in 1 year? Well, you can see, using the future value formula, the future value of an initial deposit today, we'll call that the present value, earning some interest rate R raised to the t will tell you the future value at a time period t of an initial payment of PV earning R% interest. So if I deposit $100 of a present value today, earning 6% for 1 year, I'll have 106 in 1 year. If I then allow that account to sit there for another year and get compound interest, in other words, I'm going to get interest on not just the initial 100, but also the $6 in interest. I'll let that $106 sit there in the second year, earning 6%, and I'll have $112.36. Now we can rewrite that as a $100 present value, earning 6% for a t of 2 years to get $112.36. Now what we're going to do is use Excel to calculate the future value in years 1 through 10. And then we're going to do that and graph it using a line graph with markers. So let's go ahead and start it. I'm going to launch Excel. And we're first going to type in our assumptions. The initial deposit. And I'm going to widen out that column, is $100, and by putting the dollar sign, it's automatically going to give me a format of dollars. And the rate I'm going to use is 6%. Now I'm going to use Excel styles for this course. So I'm going to go to the Home menu and select Input. Now these are generic or standard or default Excel styles. So Excel is defined in input as this gray or as a tan type color. So I'll make that an input. And I'll put some borders around it. And then I'm going to have for periods or years, well, we'll start with a 0 today and go to year 1, and then we'll extend that to year 10. Now, a simple way to get a series of numbers is type in the first 2 numbers, and then after you highlight them, drag it down, and you can see right there the number. I want to take that to 10 years. All right, so now I have set up that I'm going to get periods 1 through 10. I might center that. And I'll calculate the future value. So I'll put the first $100 right here. So today is $100. If I receive $100 a year from now, I'll take $100. I'm going to anchor that by hitting my F4 key. That'll put dollar signs around both in front of the B and the 1. That'll anchor the B row and the 1 column. I'm sorry, the 1 row and the B column. Times 1 plus the interest rate. I'm going to anchor that. Raised, and I'm going to use the little hat there, to the first power. So now you can see, I'm going to change the format to dollars, that at the end of 1 year you'll have 106. Now I can copy this formula down. Since my formula, using my formula bar here, I can see my formula is B1 anchored, so when I slide that down, that will not change. It'll stay B1. If I did not put the dollar signs, it would change it to B2, B3 as I drag it down. Times 1 plus the interest rate, that is anchored. Raised to the I power, the T power, that will change. So what you see is if I double click here, it'll actually know enough to go to the bottom of the series. And what you see in this formula is the B1 and the B2 are still anchored, but when I dragged down, it actually moved this cell reference to B15. So what these represent, I'm going to change the styles on these two to Excel's calculations. And then I'll put a border around all that. So what we see now is if I were given $100 today, that's worth $100. If I were given $100 today, 1 year from now, that will be worth 106. 2 years from now, 112, and so on. And 10 years from now, that is worth $179.08. Now I could graph that. I'm going to highlight that data. I'm going to insert a graph. So now I have a graph of the future value of $100 invested today for 1 through 10 years. And I can change the title by clicking on there, and I can say the future value of $100 received today at 6%. Now I could have used Excel's FV functions. So I could have typed an Excel function called FV. So I'll type in FV. I'll start in the first year. And you can see once I type in FV, open paren, Excel knows enough to tell me that I need the rate, the number of periods, the payment, and the present value and type. And you can see present value and type are in brackets, so they're optional. So the rate is 6%. I'm going to anchor that. The period number, I'll click on that, comma. Now in Excel, a payment is actually a series of multiple payments. So in this case, there is no series of multiple payments. We'll talk about that later. So I'm going to put 0. But I'm going to put a negative $100, anchor that as the present value. All right, so the difference in Excel is payment would you only use if there's a series of payments, say $100 a year for all 10 years. Present value is when there's one lump sum payment today. So you can see that'll give me 106. And I could have copied that down and replicated it using the FV functions. All right, so I can either use algebra to solve this problem or use Excel's future value functions. So future value is a concept of if I take an amount of money, say today, how much is it worth in 1 through 10 years? In this case, it's a lump sum. Now the next thing I want to talk about is all the areas we're going to use in the spreadsheet before we move on, and just some terminology. The file, home, insert, page, layout, etc. menus, we're going to call those the menus or tabs in Excel. Undo button, that's very important. Redo button, save. Whenever we're clicked on a cell, looks like I'm clicked on A1, gives me a cell reference. Here are the row references, 1 through 20 there, column references. We call this the ribbon. So we could hide the ribbon we want by clicking over here. I'll often use if I click on a cell, I can read the formula here, my formula bar. And I often use the borders here. I'll often center the data in the cell. And I'll also change the formats a lot. Usually I'm using decimals, percents, or dollars, or I'm increasing or decreasing the number of decimal places. And there's my cell style. So all these are part of the home menu or tab. I can also use slide bars to move up and down or across. Also in Excel, you can have more than one worksheet inside a workbook. So the file is called a workbook. You could have one worksheet, 2 worksheets, or as many worksheets as you can fit. So if I go back to Excel, you can notice it named this worksheet sheet 1. I can double click on that and change that to FV of lump sum. And then I can insert a new worksheet. And what we're going to now do is talk about the FV of an annuity. All right, going back to Excel or PowerPoint, what we're going to do is calculate the future value when you have annual payments. So say you're going to deposit $100 in a savings account today, and that's going to earn 6% per year. But in addition, you're going to deposit $100 every year at the end of each year. So $100 today, and in 1 year another 100, and so on. So in 1 year, if you do this, you'll have your initial investment of 100 plus interest, 106. Then you're going to put another $100 in there, so you have 206. At the end of 2 years, you'll have that 206 from the prior year. That'll gain interest, so that'll turn into 218, plus another $100 investment, 318. In year 4, you'll have that 318 earning interest, plus put another $100, you'll wind up with 437. So to calculate that, that's a little more difficult to do. So we're going to do that in the next worksheet. So I'm going to go to Excel. I'm actually going to go to my Future Value Lump Sum tab. I'm just going to copy this just to get some formats. I'm going to paste that here. Again, that'll just save me some time. I'll delete this. And now what I want to do is I want to add an extra input or parameter. So this is my initial deposit. I also want to do additional payments. And those additional payments will also be $100. So not only am I going to put $100 today, I'm going to make additional payments every year. So I'm going to calculate the value of that account. So again, I could start with my $100 today. Then next year, I'm going to have 100. I'm going to earn interest at 6%. Then I'm going to deposit the additional payment. I'm going to anchor that. So I'll have 206 at the end of 1 year. Now I should be able to copy that down. And what you see is if you put $100 into an account today earning 6% and then put $100 per year for 10 years, you'll have $14.97 at the end of the period. Now I could have done this with my FV function. So I can type in FV or equals FV. Put in my 6%, I'll anchor that, F4. I'll put in the period. I'll put in the payment. I'm going to put in minus 100. Since this is to putting money into account, that's an outflow. I'll make that negative. And I have an outflow. I'm going to put $100 in account today. So that's another outflow. And if I click on my function wizard there, you can see all my parameters. Interest rate is 6% anchored. Period is not anchored. Payment minus 100. And the present value deposit today is minus 100. And I could have done it that way. Whoops, I forgot to anchor those two. So let me try that again. Well, seems to be a mistake. Let's see what it is. %6 rate, period, A6, $100. Well, I guess it wasn't. So you could have calculated that using the FV function, and I could graph that, but I won't spend a lot of time doing that. All right, so this is the calculating the future value of a series of payments called an annuity and an initial deposit. Now let's talk about the concept of present value. Present value is the value today of a future amount of payments, or just one lump sum payment. So for example, you might say, well, I expect to receive $100 in 3 years from my Uncle Tony. And you determine that your Uncle Tony, appropriate interest rate to apply to this problem is 6%. And we'll talk about later, a later topic, or how to determine these discount rates or interest rates. So you're going to receive $100 in 3 years. What is that worth today? Well, the concept of present value is it's the future value discounted at some rate r raised to the t power. So $100 is my future value, discounted at 6% for 3 years would be 100 over 1.06 to the third power. So I'd say $100 received 3 years from now at a discount rate of 6% is worth $83.96. Now the interpretation of that is if I deposit $83.96 in an account today and earn 6%, it would exactly be equal to a future value of $100. So that's one interpretation. The other one is, well, how much would you pay for Uncle Tony that promises to give you 100% a year if you think Uncle Tony has the same risk as a bank that provides you 6% return? Well, then you'd say, well, I'd pay $83.96 for a promise of $100 in 3 years. That's another concept of present value. So what we're going to do is something a little bit different. We're going to calculate the present value of receiving $100 in year 1, 2, 3, 4, 5, or up to 10. So let's go ahead and do that. And again, this is just a single payment. I'm going to add a worksheet. I'm going to call it PV of lump sum. I'll copy my FV of lump sum just to get formats. Saves a lot of time. Paste. I'll delete that out. I'm going to call that a future value lump sum, $100. Still 6%, but now I'm calculating present value. So the present value of $100 received today would be 100 divided by 1 plus the interest rate raised to the t power. Now I'm going to go back in there and I'm going to anchor B1 and B2. Now if you have a Mac, you're going to have to figure out how to get the function for to work to add the dollar signs, or you'll have to manually put the dollar signs in. So what you see, $100 given today is worth $100, but if I copy that down, you'll see that 10 years from now, $100 is only worth, a promise of $100 in 10 years is worth $55 today. 3 years from now, a payment of $100 3 years from now has a present value of $83.96. And we can prove this. Let me just kind of show you how to prove this. If someone gives you, if someone is going to promise to give you $100 in 10 years, the reason why it's worth $55.84 is because I can take that $55.84 and put it in a bank at 6% for 10 years, and I'll exactly get $100. So that's the concept of present value. Now we could have done our PV function. So I could have said equals PV, 6%, period 1, no payment, remember payments are recurring, and a future value of $100, anchor that. And I'll make that future value negative sign. And I could have done it that way. All right, and I could graph that. All right. So let's now talk about present value of an annuity. So just like we did with the future value, and now talk about having recurring payments. So what if someone promised to pay you $100 a year for 3 years? So in 1 year you get $100, 2 years from now you get $100, 3 years from now you get $100. You say, well, what's that worth today? Well, I could discount 3 lump sums. $100 at 6% for 1 year, $100 discounted at 6% for 2 years, and $100 discounted at 6% for 3 years. And you can say, well, that's worth $267. So what we're going to do is a little exercise, a little different than the last 3. We're going to take the value of a 3-year, we're going to call this an annuity, which is a series of equal payments spread over equal time lengths. And we're going to use a discount rate not of just 6%, but 2, 4, 6, 8, 10, up to 20. So again, I'm going to go back to my spreadsheet. I'm going to copy my future value annuity. Well, actually, let me just copy the future value annuity just like I did last time. I'm sorry, future value of lump sum, just to get the formats. I'm going to add a worksheet. I'll slide it over there. I'll call that PV annuity. And I'll paste. Oh, try that again. Copy, paste. So for this example, I'm going to have a couple parameters. I'm going to have the payment, $100, and the number of payments, and I'll say that's going to be 3. I'm going to change that to a decimal. So 3 payments. I'm going to delete this. So I'm going to calculate the present value. And let me get rid of year 0. Now my variable here is going to be rate. And I want to start out at 0%, I'm sorry, 2%, and then 4%. And then notice what I'm going to do here. I'm going to take 2 and 4, highlight it, copy down until I get to 20. So now I have 2, 4, 6, 8, 10, 12, 14, 16, 18, 20. I'm going to now calculate the present value of annuity, of a 3-year annuity. So I'm going to actually use the annuity or present value function. I'm going to say equals PV. This is the rate, comma, 3 payments, anchor that. Each payment is $100, anchor that, and there's no other payments, so I'll just end it. And I can make that payment a negative sign, which will then make the present value a positive sign. And I can copy that down. Whoops, something's not anchored. Let me take a look. The number of payments also needs to be anchored, so let's make that F4 and F4. So if the discount rate were 6%, a 3-year annuity of $100 would be worth $267. If the discount rate were 20%, I'd only pay $210 for that 3-year annuity. So we've now done future values and present values of lump sums and annuities. Let's talk a few minutes about an infinite annuity, also called a perpetuity. What if someone promises to pay you $100 a year forever and you want to earn 6%, or 6% is your discount rate or interest rate? Well, I don't need an infinite number of rows to do that in Excel, because there's a formula that if I take my cash flow in year 1 from now, say $100, and just divide it by the discount rate, the present value of that infinite series, unbelievably, is a finite number, $1,666.67. So I would pay $1,600 for someone that promises to pay me $100 a year if I want to earn 6% of my money. You can also have constant growth perpetuities. What if someone's going to give you $100 next year, 103 after that, and then every year that cash flow is going to grow, so a little over 106 and so on. Well, the value of that constant growth perpetuity would be the cash flow 100 over the discount rate minus the growth rate. So I'd pay $3,333 if someone promises to pay me $100 next year, then 103, and then it just grows to 3% forever. So that'll be important when we start valuing stocks later in the course. A couple notes on the present value and future value functions. That rate we've been using, 6%, we're going to talk a lot about that in a future topic. How we select a rate. And I'll just give you some warnings that in finance and when I talk about it, I'll often call that interest rate, the discount rate, the opportunity cost, the rate of return, and the cost of capital. And hopefully all these will make more sense as we move on in the course. One thing you do have to notice is everything we've been doing is 1 year so far. So as long as you're doing cash flows of 1 year, the discount rate has to be an annual discount rate. But what we're going to find later is if you're looking at monthly cash flows, you got to make sure you use a monthly interest rate. Also, we haven't talked about, we'll talk about later, is types. When we're doing the FV and PV functions, so if I take equals PV, notice that type shows up, and if I click on the help, it would tell me that the type is 0 or 1 depending on when the payments are due. And what happens if you don't type anything in there for type, and it is optional, it puts in a 0. And the assumption, or the basic default assumption, is if you don't type anything, it gets a 0, and that means the end of year payments. So if I say I want a 3-year annuity of $100 and I omit it, it assumes the first one's received a year from now, and then 2 and 3 years from now. If I were to type a 1 under there for type, that means the first payment is received today, then in 1 year, and then in 2 years. Also, talk about signs. If I don't put any signs on my, say, present or payment when I did that 3-year annuity, and I ask for the present value, it'll give me a negative number. So what's happening is Excel wants to know what are outflows and what are inflows. So in this case, if I were to receive $100 for 3 years, I'd put a positive 100, and the result will give me a negative present value. What that means is that's how much I would pay today to receive $100 3 years from now. Or if I say, well, I'm going to pay someone $100 for 3 years, how much should they give me? I would put a negative sign under the payment and receive positives. Or you can just change the sign in front of the formula. So you just got to be careful with those, and there'll be some more problems where we'll have to deal with that. So let's talk about the NPV function. What if you get a series of unequal cash flows, say 100, 200, 300, 400, and 500 for the next 5 years? In that case, you want to attack what is the total value of those cash flows? So actually, I'm going to take these. I'm going to actually click on there, grab this data, get out of there, create another worksheet, and paste. I'll call that worksheet NPV. So we're going to calculate the present value of a series of unequal cash flows. So I could discount each cash flow at some discount rate, say 6%. Say $100 divided by 1 plus interest rate, anchor that, raised to the t power. So that $100 is worth $94 today. That 200 is 2 years from now is worth 178. Copy that down, and then I'll sum it up. I did a little shortcut there. Alt equals at the bottom of a column will sum up the numbers above. So it looks like I'd pay $12.14, or that's the value of all those cash flows. Now I could use Excel's NPV function. So I can type in equals NPV, put in the rate, and highlight the cash flows. And I also get my 1214 there. Although I want to be careful, this NPV function, it's not really NPV. When most people in finance talk about NPV, it is the present value of a series of future cash flows, but it's also netting against an initial cost. So it's a bit of a misnomer for Excel to call this an NPV. So let me explain. What if there was an initial cash flow in this problem? And I'm just going to copy this here. What if today you were going to pay $1,000, which is worth $1,000 today? Then you're going to receive 100, 200, 300, 400, and 500. Now, if I sum all those numbers up, the sum is 214, including the negative today. That is really the NPV, or the concept of NPV in finance. And this example is, well, what if it cost me $1,000 to buy a lemonade stand today, and these are my cash flows I expect to get for the next 5 years. What's the net present value of that $1,000 investment? So that's the concept of net present value. To get Excel to work that way, I'm going to use my NPV function, but I can only use it on future cash flows, and then I just need to add that negative initial cash flow. And that's how I get Excel use the NPV function to calculate a true NPV. And NPV, net present value, is a powerful concept in finance. It's one of the main tools for evaluating projects. So if you're looking at this project that costs $1,000 today and generates these cash flows, we take the present value of all future cash flows, subtract off that initial payment. Let me get rid of that. And this NPV is positive. It's $214. And in finance, whenever you have an NPV greater than 0, you would accept the project. Now, what it actually means is the project discount rate of 6%. What it means is this project will give you more than a 6% return on your $1,000 investment. That's why it has a positive NPV. All right, so that's a concept of NPV we're going to use later in the course. Sometimes at 6%, we call that the hurdle rate, or the rate that we want to earn on a project. So as long as the NPV is positive, that means it's earning more than 6%. Now the question you could ask is, well, what return did I actually get on that investment? It looks like it's more than 6%. To answer that, we have to calculate something called the IRR, the internal rate of return. So I know I'm earning more than 6%. When the NPV is 0, all right, or by changing the discount rate, that discount rate that makes the NPV 0 is called the internal rate of return. So I could do a goal seek here. I'm going to add a couple more decimal places to this. I could say, I'm going to do data, what if, goal seek, and I'll say, let's set the NPV to a value of 0 by changing the discount rate. In that case, that discount rate is 12.006%. That makes the NPV 0. So what I say is the IRR of this investment is actually 12%. Now I can change that back to my 6%. And I could have used Excel's IRR function. I could just type in equals IRR, type in the, or I'm sorry, put in the values, and there's my 12%. All right, so there's two ways of evaluating, or at least two ways of evaluating investment in finance. You can actually just plug in a discount rate, and the rate at which you require on this project, and if the NPV is positive, you accept the project. The other way to do it is calculate something called IRR. Just put in the cash flows, compute that discount rate that makes the NPV 0, and as long as the IRR is greater than this 6%, again, we'll call that the hurdle rate, or the required rate of return for that project, you would accept the project. So you either accept positive NPV projects, or you accept projects that have IRRs greater than a hurdle rate. And we'll talk about some complications with IRR and why professionals would tend to use NPV because of some troubles with IRR in a later lecture. All right, so that's our concept of IRR. So let's talk about a quick problem, how to do loans. What if you want to buy a new Audi A5 convertible? So let's grab some data on this A5 convertible and the loan information. That car is going to cost $55,000 today, you're going to be charged 6% annual percentage rate. So most loans are quoted at APR, annual percentage rate, but it's going to be calculated monthly. So this loan is going to be 5 years. That is actually 60 months. And I need to get the monthly interest rate. So I'm going to take the APR divided by 12. I'm going to actually be charged 0.5% per month. So we can say, well, how much is this $55,000 car going to cost me? Well, I can use a payment function in Excel where I put in the monthly interest rate, the number of months, the present value, and I can see that, notice I put a present value as a positive number because I'm going to receive that from the bank. What I'll have to pay, negative number, is $1,063.30 a month. So that's how we calculate monthly payments or less than annual payments on a loan. And the last thing we're going to do, last two things, we're going to do a little more complicated analysis using our concepts that we've learned so far. The first one is retirement planning. Suppose you're going to be 27 and you'd like to retire on your 66th birthday and withdraw a $250,000 annuity for 20 years. So when you're from your age 66 to 86, you want to withdraw, or 66 to 85, you want to withdraw $250,000 a year to live on, and you're no longer working. Now, to get to that $250,000 withdrawal, we're going to start depositing money while I'm working. So from age, say, 27 to 65, I'm going to deposit money, and then from 66 to 85, I'm going to withdraw money. Now, the question is, well, how much do I need to put into an account for the next 30 or 40 years, 39 or 40 years, to have enough money to withdraw $250,000 a year for 20 years when I'm older? Well, we can set up the spreadsheet. Now, if we go to the next worksheet, let me just grab this data, so it's going to save us a lot of time. So here's the inputs in this problem. I'm going to go down here and copy this, get out of there. Add a worksheet and paste it. Let me call this one loan, and let's call this one retirement. So in this problem, you're going to be 27 in 1 year. We'll call that 1 year from now, period 1. And we'll just take a guess. What if we think, just think, we're going to put $19,000 a year into, or $15,000 a year into an account. So I'm going to deposit $15,000 in 1 year into an account while I'm working. So that portfolio, we'll just assume end of year payments, is going to be worth $15,000. Now that $15,000, let's just assume that's going to earn 6% interest. So at the end of 1 year, we're going to have $15,000 earning 6%. I'll anchor that. And then I'm going to deposit another $15,000. So I'll have $30,900. I can then, if I anchored this correctly, let me make sure I did. Yep, this is going to slide down. That's good. So the next year, I'm going to have that $30,000 earning 6% plus another $15,000 payment. I'm going to copy that down. So when I retire at age 65, I expect to have $2.175 million. Now look what happens at age 66. I start withdrawing money. So I went from 2.1 to 2 million to 1.9 million. And I'm planning to live till at least age 85. So what you see is, oh no, I actually run out of money at age 77, which is 51 years from now. So I have a bunch of years where I'm living with my kids over here. That doesn't sound like a fun thing to do. So what I need to do is I need to figure out how much money I need to start putting into the account. 15 is not enough. So I'll have just enough money that the balance lasts till age 85. So what I can do is I can do a little goal seek. Data, what if, goal seek. Let me make sure I end with a value of 0. In other words, I just want to have just enough money that it was perfectly enough to save. So I want to set that ending balance to 0 by changing my contribution. And looks like if I put $19,767 every year into this account, I'll wind up with $2.8 million, which will exactly be enough to fund my retirement of $250 a year. All right. So now I'm going to show you a little cheat sheet or way of cheating that, and I didn't have to actually do this whole spreadsheet. Let's do a little time travel. All right, let's not pretend we're 27 anymore. Let's do a little time travel, and we're now sitting at age 65, and we're going to stop working, and I realize I need to receive a series of 20 payments of $250,000. So at age 65, if I'm looking forward, trying to figure out how much money do I need, I can calculate a present value at age 65. So I'm going to do a present value, 6%, 20 years, and I'm just going to put minus 250, or I'll put 250. All right. So if I time travel to age 65 and I'm looking forward to getting a 20-year annuity of $250,000 at 6%, at age 65 I need a present value of $2.8 million. By the way, that's what that number is there. So now at age 65 I'll say, well, how do I'll time travel again and work my way back to age 27, and I'll say, okay, now what I need is $2.8 million when I'm 65, and that becomes a future value. So now I can do a payment calculation, and if I assume a 6% return on my portfolio, I have 39 years I'm going to contribute into the portfolio, and that's how many payments here of 1976, 19,000 are there. And then I have no money in the bank today, but I need an amount of money worth $2.8 million in 39 years. It looks like I need $19,768 a year to generate a future value of 2.8, which will then generate that portfolio of $250,000, or that annuity of $250,000 a year for the rest of my life. So I could have just done this problem using these assumptions, but I like looking at the money and making sure it works. So again, we're applying our concepts of present value, future value to solve some real world interesting problems. Here's another one. Suppose you're about to be 25 in 1 year. You're going to think about entering into an MBA program that has a net cost of, say, $20,000 a year. So that's all costs, travel costs to get to this site, and apartment, and factoring in tuition and any fellowships. It's going to net cost you $20,000 a year. Now, you're currently earning $65,000 a year, and you expect your salary to go 3%, but you're going to leave that job for 2 years. And after you get out of the program, you're going to make $95,000 a year. And that's going to grow at 4% with all your extra knowledge. Let's calculate what's the NPV of our investment in an MBA. And what is the IRR of that investment? So I'm going to go and get some data I've got set up for us. Let's grab this. I'm going to copy, click out of that, and paste it here. And I'll call this MBA. All right, so let's do some analysis, financial analysis on this MBA decision. If you don't get an MBA, say you're going to make $65,000 next year, and that's going to grow at 3% forever. I'm going to anchor that 3%. So I'm just going to grow my salary at 3% a year. So this is what your life looks like without an MBA. With an MBA, I'm going to spend $20,000 this year, $20,000 next year. But then I'm going to get a salary of $95,000. That salary is going to grow at 4%, anchor that, every year. So there's my new life. So let's look at the differences. If I take my MBA minus my no MBA, I'm down 85 in the first year, 86, 950 in the second year. Then I start making more money because I've got a higher paying job, and it gets even better. Now I'm going to delete off these two here. It looks like they've got an extra 2. So now what I can do is I can take the present value of all these incremental cash flows, discounted at 6%, anchor that, raised to the year, period 1. And I can take the present value of all the cash flows. I could sum those up. Well, make sure you don't go down there. And say, oh, I made a $680,000 good decision. I created $680,000 of value. And I could have used my NPV function. Since these cash flows are all future cash flows, there's nothing at period 0. I could have just taken the incremental cash flows. Whoops, I need to put a discount rate in there first. Equals NPV. Put in my discount rate, comma, put in my values. And I could have seen there that we're creating $680,000 in value in today's terms. But you can say, well, what kind of rate of return was that on this investment of $85,000 and $86,000? Well, I can use an IRR function and just put in my cash flows. And say that I'm earning a 19% return on my investment. So with treasuries, 10-year treasuries giving me closer to 2%, that's not a bad deal, earning 20% on my return on my MBA. All right, so what we've done in this topic, we've talked about what FV is, future value lump sums, annuities, future value lump sums, annuities, how to use the payment function, the NPV function, the IRR function, and we used it to solve some 2 interesting problems. How do I know I'm saving enough for retirement? And how do I know my rate of return on this MBA investment? And we've gained some basic Excel skills for putting in formulas and functions using absolute and relative cell references. What I'm talking about there is anchoring cells. We talked about cell styles, graphing, using solver, or we actually use GoalSeek. So that's it. Here's some assignment questions, some practice, and that's it for today.